Hello and good morning. Welcome to Accounting 202, Managerial Accounting, also known as Principles of Accounting 2. I'm your host, Dr. B. I will be with you throughout the next 8 weeks as we explore managerial accounting topics. Most of you were with me in Accounting 201 earlier this semester. Some of you are new to me and to this course, and some of you are also new to the university. I want to first and foremost welcome you to a very exciting session. In this course, we will explore the principles of accounting as they relate to managers, managerial accounting, managerial decision making. In this course, we will focus on accounting from the perspective of a manufacturer. Managerial accounting has to do with how managers use accounting information to make decisions. So from this course, from the perspective, I want you to think about accounting from the perspective of a manufacturer. When you think of manufacturing, you think of assembly. You think of putting raw materials together to make a finished product and then selling that product. That's how I want you to think about the content as we explore it. Think of it put yourself in the shoes of a manufacturer, which is somebody who creates a product, manufactures it, puts it together, and then sells the product. So from that perspective, if you put yourself in a manufacturer's perspective, this course will go very easily for you. So that's why I say that. Think of it like you're a manufacturer, and I want you to keep that mindset throughout the whole course, because that'll really help you to better understand the concepts. These concepts are much different than what you learned in Accounting 201. In 201, we talked about things like journal entries, general journal ledgers, all of that good stuff. And it's very important to understand that. In 202, we're building on what you learned in 201, but we're looking at it from a different perspective. And we're going to talk about that when we go through chapter 15. Okay, so very quick, I want to help you to navigate the classroom. It's for those of you who were with me in 201, it's the same layout, same structure. Nothing has really changed from 201 except for the content. For those of you who are not with me, first and foremost, make sure that you have access to your textbook. It's super critical that you have access to your textbook. For those of you who are coming over with me from 201, it's the same textbook. So the textbook is the same exact textbook that you had in 201. To access the textbook, you can either go to the textbook link in the classroom and then select the e-textbook, it's the very first link there. Or you can also access the textbook through course content. Go to course content, select module 1, and of course it'll be under the instructional materials. The course layout. So the way it works is that each module has 2 weeks worth of content. Each week has 2 chapters. For this week, being week 1, we will cover chapters 15 and 16. For this week, you have 2 assignments. You have a Chapter 15 quiz, which you'll find in Blackboard by going to course content, going through week 1. You get down to learning activities, Chapter 15 quiz. The quiz is in Blackboard. The other assignment you have is the Chapter 16 homework. The homework is through Cengage, but you have to access that homework through the content area. So course content, learning activities, select chapter 16 homework, it'll open up in Cengage. Now again, as long as you have access to the textbook and you have access to Cengage, you won't have any problems. If for whatever reason you cannot access that, please let me know immediately so that way we can resolve that issue. It's probably your fun-loving textbook store, UDC textbook store. There's probably an error there. So again, if you have trouble accessing the homework, you need to let me know right away so that way we can get it resolved. And so each week we'll have the same exact structure. Each week we'll have 2 assignments and 2 chapters that we'll cover. And for those of you who are with me in 201, it's the same structure, same format. So the first thing you should do when you come into the classroom, of course, read through the announcements, click Start Here, go through all of that wonderful content. And, of course, go to your discussion board and introduce yourself if you haven't done so already. Now, all of you have come with me from 201 to 202, and there are a few new students here in 202. So please introduce yourself to your classmates. I do want to highlight a couple of pieces of information, one of those being the office hours. Office hours, very simple. If you want to schedule office hours with me, all you do is click on the office hours link, click on the 30-minute office hour session, and then select the date. It'll be available it'll be highlighted in blue. Just click on whatever date you want to meet with me and then a respective time slot. I'm available on Mondays, Wednesdays, and Fridays. Mondays and Wednesdays, I'm available from 11 to 3. And on Fridays, I'm available from 10 to 2. So please feel free to schedule office hours with me. I would be more than happy to meet with you. Especially if you're having trouble understanding course content, that is what I'm here for. I am here to teach. So please feel free to meet with me anytime that you need it. Also, if those hours don't work for you, please send me an email. We can either schedule an outside time or I can help to address the situation with you through email. Most of you earlier this semester took advantage of that, and I appreciate those of you who didn't take the time to meet with me. I find it to be very beneficial. Okay, so those are my quick comments. Now let's go ahead and get started with Chapter 15. So for those of you who want to follow along with the slides, to find the PowerPoint presentations, click on Course Content, select Module 1. So week 1, if you come down to Instructional Materials, by clicking Next a couple of times, I'll fix that. That's a quick thing. Come down to Chapter 15 and 16 PowerPoint. You can download both of those and follow along if you like. So, okay, let's go ahead and get started. Chapter 15. Chapter 15 is the Introduction to Managerial Accounting Concepts and Principles. This chapter is relatively quick. It's not as complicated as Chapter 16 is, but there are a couple of key concepts I want all of you to understand. And again, as we continue throughout our WebEx sessions, if you have a comment, question, or concern, just feel free to unmute yourself and ask your question. I'll be happy to answer it. Okay, so Chapter 15, what is managerial accounting? As you know, with accounting, it's divided into 2 separate areas. We have financial accounting and managerial accounting. In financial accounting, we were concerned about preparing financial statements for the use of external users. External users are people like investors, banks, the government for taxation, people outside of the company. Those are external users. And of course, company management, which is inside the company, you also need to understand the financial statements. The objective with for financial accounting or through the financial statements is that they are objective. They are prepared according to generally accepted accounting principles. They are prepared at fixed intervals, such as the end of the month, end of the quarter, end of the year. And they focus on the company as a whole. In managerial accounting, we're more concerned about managerial reports, which are different than the financial statements. Managerial reports provide the managers with information to make decisions. Examples would be a production report, activity analysis, a budget report. All of these are not prepared for external users. They're only used for managers. And managers use these internal reports to make decisions. They're both objective and subjective. They're prepared according to what managers need. They're prepared at fixed and on-needed basis. And they focus on the company as a whole or by departments, also known as segments. So that's the primary difference between financial and managerial. Managerial focuses on management's needs with internal use only type of stuff. That's why you don't see budget reports or production reports being published for the general public to see, because there's no need for them to see that. That's why they're not prepared to GAAP. They're only used for managers' use. So again, financial reporting, financial accounting, which was Accounting 201, focused on general accepted accounting principles, financial statements that were prepared for external users. They were prepared monthly, quarterly, and yearly, and they were used by shareholders, creditors, government agencies, and the general public, which is much different than managerial accounting. Managerial accounting, we focus on the management of the company and the specific needs. That's used by managers, planners, organization leaders, people within the company. It focuses on historical data used to provide measurements of the past and also to provide estimates for the future. And all of these help managers to make decisions on the company. So again, the differences between the two is that the managerial accounting does not have to comply with GAAP because it is not made publicly available. Remember, GAAP, which is generally accepted accounting principles, only focuses on financial statements that are prepared for the general public use. While some managerial statements are prepared at fixed intervals like monthly, quarterly, and yearly, for the most part, they are generated as managers need them. So there's no specific time frame when it comes to managerial accounting. And these are prepared for the business to use as a whole, and typically by managers of the company. Now, the thing to understand about managerial accounting is you need to know how the organization is structured. And you can take a look at this by looking at the organizational chart. I'm sure you probably learned about this in your Introduction to Business course already. For those of you who are still in it, I'm sure you're learning about it now. Lakeisha, go ahead.
Yes, Professor. Yes. How you doing? I'm wonderful. How you doing? It's so good to hear from you.
Good to hear you too.
I have plenty of questions, but I was just applying for a job, and it was asking me how many years, like how many years of like manager or supervisor experience do you have? Can you be taught to be a manager? Like, I mean, can someone teach you to be a manager? Is it a process you have to go through to be a manager? Or can I just come in and I have no manager experience and be a manager?
So, wonderful question. The short answer is yes, it's taught. It's something that requires some training, both on the job and in school. And it is also something that it's learned. It's a learned process. The process to become a manager is you work with a current manager of an organization. Usually you can find a position to become a manager through what we call a manager in training, process. Become a manager in training, you apply to a manager in training position, or you apply to an associate role and eventually work your way up the ladder.
Professor, can you please work with me this semester on that? I really would love to do that. And just you speaking of everything, like just speaks my volumes. And it's like something that I want to do. It's like my career path. And it's like something I really, really want to do. I really want to get the experience and really want to be a leader. So I really would love to do that and like really change the whole game, of the manager. Because it's a lot of businesses out here that's failing because they're lacking management.
That's right. That's right. 100% right. Yes, it'll be my pleasure to work with you. No doubt. So, but thanks for those questions.
Thank you. Thank you.
Yeah, absolutely. Yeah, so looking at the organizational chart of a company, it's typically broken out by departments or similar responsibilities or functions or activities. Here's an example of an organizational chart. Typically at the top of the chart, you have your president and or CEO or what they call an executive officer at the nonprofit level. We, under the president, CEO, executive officer, there are departments. I call these department managers or various departments, right? This department is administration. This department is the brand management. This department is manufacturing. This department is accounting. Each department at the top level, you have a department manager. In accounting, it's the CFO or the controller. In production, you usually have a vice president of production or a plant director. In marketing, you have a vice president of the brand or a brand manager or brand director. And in administration, you usually have administration officer or a vice president of administration, something like that. These are just examples of titles, right? But the idea, the reason behind me showing you this chart is that at the top of each department, there's typically some type of officer or vice president or somebody who's in charge of that department. And then underneath that person, there's typically other managers or directors or someone in some type of responsibility role. You have other vice presidents, other managers for each department. Under each president, there's a manager. Under each manager, there's employees. And then if the organizational chart kept going, under vice president for human resources, you'd have payroll, onboarding. So these are other positions, right? Under director for the brand, you would have a manager for each brand and each area. Under the plant manager, you might have line managers. Under the controller, you might have accounts payable, accounts receivable, payroll, so forth and so on. But this just kind of give you an example of how organizations are developed, how they look from an organizational perspective. But the key thing I want you to take away and to understand about managerial accounting is that managerial accounting is really broken out by either department or by activity. That's the important thing to understand here. So each department typically has line responsibilities and staff responsibilities. Line responsibilities or line departments are directly involved in providing goods and services to the customers. For example, the line positions in the organizational chart that we just saw would be your vice presidents and your managers. That's that second line down. In staff departments, these provide services, assistance, and advice to departments that are in other areas. When you think of line department, when you hear line department, think of directly involved with customers. When you think of staff department, think of support. Staff department is support. These are roles that are not directly faced with customers. This would include departments like administration, human resources, accounting. These are roles that do not directly interface with customers, but they do support the roles that do. In accounting, most companies have a controller that's responsible for the accounting of the organization. For example, those of you who know me, I was a financial controller for 15 years. I was a financial controller for Radisson Hotels for several years. Before that, I was a financial controller for retail organizations. I have a lot of financial controllership experience. My role and responsibility, I was responsible for the accounting of the organization. That included things like uh, budgets, payroll, taxes, cost accounting, general accounting, so forth and so on. I was essentially responsible for all of the accounting functions. And most controllers are responsible for systems, procedures, general accounting, budgets, and budget analysis, special reports, taxes, and cost accounting. Don't worry, we'll talk more about those things as time goes on. In the management process, to manage a business, there are 5 areas, 5 responsibilities that you need to be aware of. These are 5 phases, I guess you could call them. The first phase in business is to plan. You have a plan for your business. You have a plan for production. So again, with managerial accounting, I want you to think about production. Think about manufacturing. And in the example we're going to have in this chapter and in future chapters is we have a company that manufactures guitars, okay, musical instruments, guitars. In our manufacturing business of guitars, we have the first phase of managing that business is planning. We have a plan to manufacture guitars. The second phase is directing. We have direction of how to manufacture the guitars. The third phase is controlling. We have a control process of how we manufacture the guitars. Phase 4 is improving. We continually improve our manufacturing process of guitars. How do we do that? Then step 5, or phase 5, is decision making. And then we continue the cycle again. We plan, direct, control, improve, and then make decisions. And we do it all over again. This is the cycle for the management process. And here's how it looks from a graphical representation. First, we plan. Our operational plan tells us what we need to do. We put that plan into action through direction. By directing, we put it into action, and then we actually create the products. And from there, we make improvements based off of the results. From our improvements, we make decisions. And in decisions, we're controlling, we're improving, we're directing. Decision making is at the center of the management process. We make decisions to plan. We make decisions to improve. We make decisions to operate. We make decisions to control. And all of this is driven based off of feedback. It's kind of how the visualization of this looks. But don't worry, we'll break it down a little bit further. Management uses plans in the development of companies' objectives and translating those objectives into a course of action. In business, we have a strategic plan. It kind of guides the business of long term. That's strategy. We create a strategy for the next 5 to 10 years, or 1 year, 1 year to 5 years, 5 years to 10 years. It's a long-term plan. That's a strategy. The strategic plan helps us to actualize our long-term goals and objectives. So long-term objectives are called strategies. And then we also have operational plans. These are the day-to-day operations of the company. The plan today is to make 100 guitars. The plan tomorrow is to make 110 guitars. The plan the next day is to make 120 guitars. Operational planning is day-to-day operations of the business. That also includes things like purchasing raw materials, using allocating raw materials for the manufacturing process, taking it from the manufacturing process to finished goods, and then getting those finished goods ready for sale. That's the operation. And we plan at each step of the operation. Don't worry, we'll talk more about operations in great detail, especially over the next few chapters. And then, of course, after planning, we have directing. Directing is how the managers run the day-to-day operation of the business. How do they direct it? Then we have controlling. Controlling is monitoring the operations results and comparing the actual results with the expected. Okay, we do the same thing in budgeting. You know that we take our actual budget, we compare that to our planned budget. We take our actual sales and we compare that to our planned sales. We take our actual expenses and we compare that to our expected expenses. That's a process of controlling. The feedback that we get from controlling allows managers to isolate potential issues for further investigation and to interject to mitigate any potential problems. The philosophy of controlling is comparing actual to expected. That's the idea behind controlling, and we call that the management by exception. The next phase is improving. We continually improve in business. That's how we are successful. We continually improve. Continuous process improvement is the philosophy for continually improving employees, business processes, and products. An example, I continually provide training to my employees. By continuous training, they are continually improving. For the business process, I continually make improvements to the business process by shortening the processes, by automating processes. I'm continually improving the process. And I also make continuous improvements to products. As technology improves, I modify the product based off of those improvements. As time goes on, I change the product slightly to get my customers to continue to like that product. An example would be, we went from the iPhone 10 to the iPhone 11 to the iPhone 12. Every iPhone advancement that was made was a continuous improvement to the product. Cell phone companies are notorious for making continuous improvements to their products. The objective here is, of course, to eliminate the source of problems in the process. And in this way, we improve the overall product or service and make sure that they are delivered in the right quantity at the right time. We call that just in time. We'll talk more about that as time goes on. Decision making. As you know, decision making is an inherent process within management. We make continuous decisions. In the company, we must continually make decisions among alternative actions. For example, I have decision A or decision B. Decision A will cost me more, but decision B will be less effective. Which decision do I make? And I look at all of the possibilities to make a decision. And what does management do with all of this information from an accounting perspective? Managers look at the accounting data, the accounting information, and reports for managers to improve the operations of the business. Managerial accounting provides cost of manufacturing a product, which can be used to determine the selling price. Managerial accounting allows for the comparison of costs of manufacturing products over time and can be used to monitor and control cost of direct materials, direct labor, and factory overhead. Okay, I just said three key terms, okay? Direct materials, direct labor, and factory overhead. I want you all to understand these three terms: direct materials, direct labor, and factory overhead. These are the three elements that go into manufacturing a product: direct materials, direct labor, and factory overhead. Direct materials, those are the raw materials that I use to create a product. Those are my inputs. I input direct materials, raw materials. Raw materials will be like if I'm making a guitar, for example. I'm going to use wood. I'm going to use string. I'm going to use metal facets. I'm going to use some plastic. Those are my direct materials. Direct labor are the people that make the guitars. Direct labor. Direct labor are the people that actually do the manufacturing. That's direct labor. Those are the people on the assembly line that make the guitar. The people that carve the wood. They're the people that glue the wood together. They're the people that put the strings on the guitar. That's direct labor. The people that directly impact the product that's being made. And then you have factory overhead. Factory overhead is everything else. It's the lights that are used for the machines to make the guitar. It's the building itself for the rent for the space. It's the managers' salaries that oversee the manufacturing process. It's the people who clean the factory. That's factory overhead. Overhead's kind of like everything else, right? So just please remember those three things. We'll talk more about them, but I just want to make sure that you have a basic understanding of what they are before we go on. Managerial accounting also involves performance reports that allow management to identify large amounts of scrap materials or employee downtime. Scrap materials. When I'm making a guitar, I have metal shavings. I have leftover wood that I didn't use. That's called scrap material. It's material that is left over after I've made the guitar. That's scrap material. I also have employee downtime. Employee downtime is when the employees are not working. They're sitting around. They're waiting for materials to come in from the truck. They're sitting around. They're waiting for the manager to come tell them what to do. That's employee downtime. Okay, we call that idle hands. When idle hands are in the shop, they're wasting money. Okay, employee downtime. We use reports that can analyze potential efficiencies and dollar savings to purchase computerized equipment to speed up production processes. This is like using computers to help the employees to be more efficient. Instead of an employee crafting things by hand, the employee might feed the material into a machine that does it for them. It speeds things up. And then number 5, a report can be used to analyze how many units we need to sell to cover the operating and costs and expenses. We call this break even. Break even. Break even is how many units we need to sell to cover our expenses. Call that break even. This information is used to set monthly selling targets bonuses for sales personnel. Let's talk more about manufacturing operations. These are the operations of the business that can be classified as a service, merchandising, or manufacturing. In most managerial accounting concepts, we apply to the manufacturing business because it also applies to service and merchandising businesses. In manufacturing operations, for a guitar manufacturer, for example, we're going to show that to you now. This is the process by which we manufacture. We are, the customer places an order with us. They want to buy some guitars. Great. So we'll manufacture those. We will take our raw materials, which are our wood, our strings, our other pieces of metal to get it all together. We'll take our raw materials. We will then start the assembly process. First we'll do is we'll process the material. We'll cut the wood to make the shape of the guitar. From there, we'll start the assembly process. We'll attach the neck of the guitar to the body of the guitar by gluing and soldering and whatever else. And we'll put the strings on and all that good stuff in the assembly process. After that, we take the finished product from assembly, we move it into our finished goods. That's the finished guitar, and that's ready for sale. This is kind of a nice illustration of the process. Now, here's the thing. There's a lot of cost involved, and this is where this chapter gets important, okay, is by cost. A lot of what we're going to talk about in this course is based off of cost. As you know, a cost is a payment of cash or the commitment to pay cash in the future for the purpose of generating revenue. That's what a cost is, a cost. In managerial accounting, the costs are classified based off of the activity or based off of the decision-making process. We typically group costs that are somewhere together. So, for example, costs are often classified by the relationship to the segment of the operation. We call these object costs. Object costs. This is kind of like grouping like costs together in a cost object. Cost object, it could be a product, it could be sales territory, it could be a department or an activity. Think of a cost object like a cost pool. We put similar costs together to create a cost pool. These are similar costs together, cost object. Now, here's the important part. I really need you to think about this. When we talk about costs, we have two types of costs. We have direct cost and indirect cost. Direct costs are the things we can directly trace to the product, to the finished good. I can directly trace to the finished product. That's direct cost. That would include things like direct materials, direct labor, and direct factory overhead. I can trace those directly to the product. Direct materials, that's my raw materials. My wood, my brackets, my wood varnish, my strings. That's all direct materials. Direct labor, that's another direct cost, direct labor. Those are the people making the guitars. And then my direct factory overhead, that's the electric that's directly tied to the machines. That's the rent for the space of the assembly line. That's the cost of running the machines. That's all a part of direct factory overhead. Those are direct costs. Then we also have indirect costs. Indirect costs are things we cannot directly trace to the manufacturing process. These would be things like office salaries. These would be things like the salary of the controller, the office administration salaries, office expenses like the printer paper, office supplies. Those are things we cannot directly tie to the manufacturing of a guitar. So we classify those as indirect costs. Does it make sense? Are there any questions so far? Are we okay?
I guess ain't nobody else gonna say nothing. Yeah, I'm following you.
Okay. Thanks, Darian. I always appreciate you when you affirm that you understand. It's important to me.
All right, thank you.
I'm listening, Professor. I was talking to my daughter. My
That's
bad.
okay. I appreciate, Lakeisha. It's important that you all understand the concept. So that's why I asked the question. Thank you. Okay. So let's keep going. So here is an illustration of direct costs. Here's the illustration of direct costs. We have our direct materials. Again, our raw materials, our wood, our metal components, our string. That is a direct cost, our direct materials, because it directly corresponds with the finished product. Direct materials are the materials used in the manufacturing process to create the finished product. Lakeisha, are you good?
Yes, I'm trying to mute my screen. I'm just having a difficult time. I'm trying to tell my kids to be quiet because I'm trying to mute my screen.
Nope, no problem. I got you. Okay. Indirect costs. The production supervisor's salary is an example of an indirect cost. The reason being is because the production supervisor is not actually manufacturing the product, he's just supervising the people that do. Okay? That's why the production supervisor's salary is not a part of direct cost because he's not touching the physical product. Think of direct cost, you're physically touching the product. Indirect cost is when you cannot physically touch the product. Make sense? Yes? Great. So indirect cost would be the production supervisor. We cannot directly trace his entire salary to the production process, so therefore the supervisor's salary is an indirect cost. We can allocate part of it, but not all of it. Okay. Okay. How do we classify direct and indirect costs? We identify the cost object. In this case, it's the finished product. It's the guitar. Then we determine if the cost can be identified directly with the product or not. If it's traceable, we call it a direct cost, meaning can we trace the cost back to the finished product? That would include things like direct materials, direct labor, factory overhead. Things we cannot trace back to the finished product, we call that not traceable, and those are indirect costs. Now, again, more important things to understand. And I mentioned this a little bit earlier, but we're going to dive a little bit deeper on manufacturing costs. Primarily, we're going to look at direct materials, direct labor, and factory overhead. These these three things, direct materials, direct labor, factory overhead, you really, I'm telling you now, you need to understand these completely, because these will continue to come up throughout the next several chapters, pretty much throughout the entire course. You're gonna hear me say over and over again, direct materials, direct labor, factory overhead. So it's very important that you understand direct materials, direct labor, factory overhead. The cost of a manufactured product includes cost of the materials used to make that product. In addition, the cost of the manufactured product includes cost converting to the materials of a finished product. We call these, the costs that make up a finished product include the direct materials, the direct labor, and the factory overhead. Again, direct materials are the raw materials used to create the product. Now, in our example of a guitar, it's wood, it's the wood, it's the string, it's the metal facets. The direct labor are the employees directly creating the guitars, and the factory overhead are tied to the production, which include the electric for the assembly line, the machines on the assembly line, the conveyor belt on the assembly line, anything directly related to that product. Factory overhead. So again, tying it back together, direct materials, that's your wood, that's your string, these are your raw materials. That's direct materials. Direct labor, that's the people putting the product together and the assembly process. And then, of course, your factory overhead, those are your lights, that's your building space, that's your the building itself, that's the part that's allocated to the assembly process. That's factory overhead. So let's break it down even further, because I really need you to understand direct materials, direct labor, factory overhead. So let's go again with direct materials. Direct materials, manufacture products using direct materials to create the finished product. Direct materials cost, it must be two things to be called direct materials. It must be an integral part of the finished product, meaning if the direct materials must be most of that product. So in our example of the guitar, most of that product is made by wood. So wood is an integral part of the guitar. String is also a key component of the guitar. So string is a part of the direct materials. The metal facets that connects the pieces together, clearly very important. So again, that's a part of the direct materials. And it must also be a significant portion of the total cost of the product. So the guitar, mostly comprised of wood and string and facets, those three things together must equal a large amount of the cost of the guitar. Other examples of direct materials costs include things like the cost of the wood used in the producing, the cost of the electric components for a television, the microchips for a computer, tires of an automobile. These are examples of direct materials, right? The idea that you need to remember is direct materials must include things that make up most of that product. And they need to be important for creating that product. Now on to direct labor. Direct labor, these are the employees that directly interface with the manufacturing process of the product. The cost of the employee's wages, which is usually hourly, by the way, it must be an integral part of the manufacturing process of the product to make the finished product. Two things must be true. Direct labor must be an integral part of the finished product, and it must be a significant portion of the total cost of that product. Examples would be the employee wages who cut the guitar wood and assemble them. Those are direct labor. Mechanics who repair an automobile, that is a part of direct labor. The machine operators and the manufacturer to manufacture tools, direct labor. Assemblers who assemble computers or guitars or whatever, direct labor. In other words, the direct labor is the wages that can be tied directly to the finished good. Now let's look at factory overhead. Factory overhead is a little bit more gray, but let's talk about factory overhead. Factory overhead costs are costs that are other than direct materials and direct labor that can be directly tied to the process. We call this factory overhead. Sometimes it's called manufacturing overhead or factory burden. In most cases, you'll hear it called factory overhead costs or manufacturing overhead. All factory overhead costs are indirect costs that are related to the product being produced. These would include things like heat and light for the factory, repair and maintenance, property taxes, insurance, depreciation. These are all things that are we tie to the building, and the building is where the products are being made, but we can't tie all of this directly to the product. We can tie most of it to the product or a portion of it. That's why we call it factory overhead. We'll talk more about that. Factory overhead costs include materials and labor costs that do not enter directly into the finished product. An example would be we can tie the janitor expenses and the supervisor expenses, but not all of it. So what we typically do here is we attribute a percentage of the expense to the product. We'll talk more about how that works in the future chapters. Also, if there's cost of direct materials that are not significantly portioned to the total product cost, these costs may be classified as factory overhead. And we'll talk. Don't worry. We'll talk more about factory overhead. It's a little bit more cumbersome, but we'll do a deep dive on that, especially in future chapters. Okay, more costs. Okay, let's talk about prime costs and conversion costs. When we talk about direct materials, direct labor, and factory overhead, there are really two types of costs that go into these elements. The first one is prime costs. When you hear the word prime, think primary. When you hear primary, think first. Prime is primary is first. Prime means primary. Prime costs or primary costs consist of direct materials and direct labor, because direct materials and direct labor are key factors in the production process. Direct materials, direct labor, factory overhead. Direct materials and direct labor are what we call prime costs. So they're the first costs that go into the production process. Then we also have what we call conversion costs. Conversion costs consist of direct labor and factory overhead costs. Think when you hear the word conversion, think conversion. We convert costs. Conversion costs are costs of converting materials into a finished product. In the manufacturing process, we have direct materials, direct labor, factory overhead. If you think about the manufacturing process, we take our raw materials, we move those into work in process, which is the assembly process. This is the actual manufacturing process on the assembly line. We converted it from raw materials to work in process. Then we convert it again from work in process to finished goods. That's conversion. We'll talk more about that later on, but I just want you to understand the difference between prime cost and conversion cost. The conversion cost is, it says that it primarily deals with converting the materials into a finished product. And through this, we use direct labor and factory overhead. And of course, direct labor is both a prime cost and a conversion cost. Don't worry, we'll get more into it, but I just want you to get a basic understanding. Prime cost and conversion costs are both, as you know, a part of the manufacturing process. Prime costs, we said, were direct materials and direct labor. Those are your prime costs. And your conversion costs are your direct labor and your factory overhead. So think of it as a process, okay? It goes from direct materials to direct labor to factory overhead. And there's a process. The prime costs, direct materials, and direct labor go into the conversion costs, which are direct labor and factory overhead, to get ultimately to the finished product. Oh my, I know, it keeps going, right? There's a lot of costs involved in manufacturing. Here's some more costs for you. Sip of coffee. Okay. For financial reporting purposes, costs are classified into product costs and period costs. You all remember this from Accounting 201. We talked about product cost and period cost. Product cost, as you know, consists of the manufacturing cost. That would be direct material, direct labor, factory overhead. Direct material, direct labor, factory overhead. Those are your manufacturing costs. Those are your product costs. Then we also have period costs. Period cost is the selling and administrative expenses that are incurred through marketing of the product and delivering the product to the customer. It would also be the administrative expenses for the management of the company that are not directly related to the manufacturing or selling functions. Here's how I want you to think about it. Product costs are direct costs, and they are tied directly to the manufacturing process. Period costs are not directly tied to the manufacturing process, but they are a part of getting the finished good to the customer. These will be selling and administrative expenses. So here's a nice visual representation of this. Product costs are manufacturing costs, include direct materials, direct labor, factory overhead. Non-manufacturing costs are known as period costs, and these would be selling administrative expenses and selling and administrative expenses. These are not a part of the manufacturing process, but they are related to getting the finished good to the customer. Any questions so far? Are we okay? Darian? Are we okay, or are there any questions so far?
We good.
Thank you so much, Lakeisha. Appreciate it. Rolling on. Product costs and period costs. The product costs are incurred as they are recorded and reported on the balance sheet as inventory. When inventory is sold, we call it cost of goods sold, as you know. I'm sure you all remember cost of goods sold. Cost of goods sold is generated when we sell the product. In the production process, we move inventory as it is processed. What do I mean by that? When we talk about managerial accounting, we talk about the manufacturing process, we talk about inventory. There are three parts of inventory I need you to understand. There is raw materials inventory. There is work in process inventory. And then there's finished goods inventory. Raw materials inventory, that is the materials that have not yet been processed to make the finished good. Raw materials inventory, that is your wood, your string, your metal parts that have not yet been introduced into the manufacturing process. That's what you have sitting in inventory that has not yet been processed. It's sitting out there on your shop floor in a corner waiting to be used. Okay? That is what we call raw materials inventory. Then you have work in process inventory. Work in process inventory is the inventory you have on the shop floor, on the assembly line, currently being processed, currently being made into a finished good. That's work in process inventory. And then last but not least, you have your finished goods inventory. Finished goods inventory means they've been assembled, they're ready and available for sale. Ready and available for sale. That is finished goods inventory. Don't worry, we'll talk more about that. I just want you to understand that on the balance sheet, you have raw materials, work in process, and finished goods all within your inventory on the balance sheet. And we'll talk more about that later in the chapter and in the next chapter. We also have period costs. Period costs, as you remember from 201, these are reported as expenses on the income statement and the period in which they were incurred. You remember accrual-based accounting. We talked about period costs. Period costs are expenses on the income statement that are on the income statement when they occurred. And so period costs never appear on the balance sheet because period costs are expenses. And as you know, revenue, expenses, net income, those are parts of the income statement. Here's how it looks graphically. We have costs for the purpose of generating revenues. We have product costs and period costs. Product costs include inventory and cost of goods sold. Product costs, inventory is on the balance sheet. Cost of goods sold, as you know, is on the income statement. Inventory includes raw materials, work in process, and finished goods. Cost of goods sold on the income statement. We take our finished goods. When we sell it, it becomes cost of goods sold. And you remember that from 201. On the other side, we have period costs. Period costs include selling and administrative expenses. Those go directly to the income statement. They do not appear on the balance sheet. Okay, that's the important stuff. Now let's talk about the not so important, but somewhat important. Sustainability. Sustainability means the company is stable and is able to stay in business. It also talks about natural resources and social natural and social environments. Sustainability is a practice of the business to maximize its profits, but also attempts to preserve the natural environment, the economy, and the needs of future generations. Sustainability is a practice by which we recognize impacts on the natural environment and the social environment. Companies, as you know, try to be naturally and socially conscious. Okay? There are a lot of movements that companies get involved in, both naturally and socially. And the companies try to do good for the social and natural environments. Examples would be for farming sustainability by using less manure, by enhancing the crops to become stewards of the environment. Energy is another category by which we are converting gas to renewable energies. Engineering and construction, buildings are being built by being more energy efficient. Transportation, we're using biofuels, electric vehicles, things like that to become more sustainable. Waste minimalization, we use recycling, composting, reusable products to be more sustainable. Businesses engage in these activities because they are more environmentally and socially aware. Let's see, where am I? Sustainability information can be used for companies in their strategic decision making. Managers are always looking at ways to increase revenue, reduce or control costs, and be efficient when using resources. Eco-efficiency is a measure by which accounting information helps managers to evaluate the savings generated by being more efficient with their operations. The Sustainability Accounting Standards Board was organized in 2011 to help companies become more conscious and sustainable by reporting on their sustainability efforts in the financial statements. Here's some more examples of that: energy efficiency, use of materials, fuel efficiency, and waste efficiency. On the financial statements for a manufacturing business, retained earnings and cash flow statements for a manufacturing business are very similar to the services and merchandising businesses. However, the primary differences are on the balance sheet and the income statement for a manufacturing business, where you'll see that it's a little bit more complex because it produces the inventory that it sells, and it reports product costs. The balance sheet for manufacturing business, as I said before, and I'll say it probably several times more, on the balance sheet under inventory, there are materials, work in process, and finished goods inventory. Materials inventory, those are your raw materials. That consists of costs for direct materials and indirect materials that have not yet entered the manufacturing process. Work in process inventory have already entered the manufacturing process, but they have not yet been completed. And then finished goods inventory are your completed goods that are ready and available for sale to your customers.
So, Professor, so this is basically would be, so the inventory basically goes on a balance sheet also.
Correct.
So basically you see what goes in and what comes out, what you have what you have coming in and what you have going out. So basically your material use is what you are building to get I guess to get to the customer. So your raw materials are the materials that you're assembling, right? To get together,
Right.
to put together. The work in progress is the work that they're putting together to get the finished goods out the door, right?
That's
so
correct.
when they got that, so the work in progress meaning okay, they're building a guitar, okay, we're putting it together. The finished goods meaning that the guitar is finished. Now it's ready to be sold. Like, so it haven't been sold yet, but now it's ready to be out, for as part of the finished goods, correct?
That's correct, 100%. Yep.
Okay.
So think of it from a process perspective. First, it's raw materials, which is your materials inventory. Then we take it out of there and we put it into work in process. Once the guitar is done being manufactured, we take it out of work in process and put it into finished goods. Exactly. Very good. And here's how it looks on a balance sheet. within your inventory line, and you guys remember the word we used in the Accounting 201, we called it subsidiary ledgers. Subsidiary ledgers.
Yeah, subsidiary.
Yep. So inventory is the primary ledger. The subsidiary ledgers within inventory are direct materials, work in process, finished goods. So on the balance sheet, you have your inventory, 142,000. Now to how we got there. So in inventory, we have direct materials, work in process, finished goods. You add up direct materials, work in process, finished goods to get to your total inventory. So just an example. On the income statement for a manufacturing business primarily has the reporting of the cost of goods sold. So on the income statement for manufacturing business, we have cost of goods sold. Costs, which is, so we take our beginning finished goods minus our cost of goods manufactured to get to a cost of goods sold available for sale. Or plus, beginning finished cost of goods inventory plus cost of goods manufactured equals the cost of goods available for sale. Minus our ending inventory to gets us to our cost of goods sold. Okay, so let's break it down a little bit further. In a merchandising business, which is different than a manufacturing business, a merchandising business, is that company that sells products that they purchase somewhere else. They didn't make it themselves. That's a merchandising business. In a merchandising business, like Macy's, for example, they take the beginning merchandise inventory plus their purchases equals merchandise available for sale. In a manufacturing business, it's a little bit different. But looking at this from a merchandising perspective, beginning balance plus purchases equals available for sale. Then we get cost of goods sold, cost available for sale minus ending inventory equals merchandise that we cost of merchandise sold. In the manufacturing business, it's beginning finished goods inventory plus cost of goods manufactured equals cost of finished goods available for sale. To get to the cost of goods sold, we take cost of goods available for sale minus the ending inventory and equals cost of goods sold. Cost of goods manufactured is required to determine the cost of goods sold and thus prepare the income statement. The statement of cost of goods manufactured is one of those managerial accounting reports is a statement of cost of goods manufactured. And this tells us the cost of goods manufactured that is determined. Now here's an example of a statement of cost of goods manufactured. We have our beginning work in process inventory. And then we have our direct materials. Beginning materials inventory plus any purchases equals cost of goods available for use minus our ending materials inventory equals our cost of direct materials used plus our direct labor plus our factory overhead equals our total manufacturing costs incurred for the period. We take our beginning work in process inventory plus our total manufacturing cost of goods for the period equals our total manufacturing costs minus our ending work in process inventory equals our cost of goods manufactured. So just kind of look at this and remember this formula. It'll help with, I believe, one of the quiz questions. Okay, so the statement of cost of goods manufactured is prepared using 3 steps. 1, determine the cost of goods materials used. 2, determine the total manufacturing costs incurred. And 3, determine the cost of goods manufactured. So how do we do that? We take a look at the income statement. Sales minus your cost of goods sold. Cost of goods sold is made up of finished goods inventory at the beginning of the period, plus our cost of goods manufactured equals cost of finished goods available for sale minus finished goods at the ending inventory equals cost of goods sold. Sales minus cost of goods sold equals gross profit minus your operating expenses equals net income. Okay, here's a nice flow chart for those of you who like flow charts. Your manufacturing costs. Remember, anytime you hear manufacturing costs, think direct materials, direct labor, factory overhead. We use these three things in the manufacturing process. When we haven't finished it yet, we call it work in process inventory. When we finish the manufacturing process, we call it finished goods inventory. For inventory we have not used yet in the manufacturing process, the direct materials that we have not yet used, we call that materials inventory. And then, of course, after we've finished our manufacturing process and it becomes finished goods inventory, when we sell it, after we sell it, we call it cost of goods sold. That's the flow chart. And here's a nice example of what that looks like on your income statement. And here's a nice breakdown of what that looks like. Cost of materials used, beginning balance plus purchases equals cost of materials available for sale minus the ending balance inventory equals your cost of direct materials used. You can follow the same process. Total manufacturing cost, you take your direct materials plus direct labor plus factory overhead equals total manufacturing cost. Cost of goods manufactured, beginning work in process inventory plus total manufacturing costs equals total manufacturing costs minus work in process equals cost of goods manufactured. And that is the end of chapter 15, our very first chapter for Accounting 202. Are there any questions so far for
No,
chapter 15?
no, Professor, what I'm doing, this Lakeisha, what I'm doing is I got my book in front of me and everything you said, like I'm writing out all of my notes, like everything that stands out because I noticed in the first session, like I was going through the book, but I wasn't like really getting down to the details of the work. Like I was writing down the notes, but I was forgetting. Like now I'm more organized. Honestly, the first class really helped me prepare for this class and be more organized. And so now I'm more organized and prepared and see how everything flow. Because honestly, the statements is what was getting me. I was like solely lost. But as you was like explaining, like you start, with the raw materials, and then you go on from this is like step 1, step 2, step 3. And if I looked at that, it makes it easier to understand. And like you said, this is different from the first accounting 101. This one is a little different, and really you have to like really go back. You see how it takes steps. It's a process,
That's
and
right.
it is. That's the way I'm looking at it. Like it's a process, and it's a way that then you can't jump to step 3 before you do 1. You know what I'm saying? So it's like I'm
Exactly.
taking everything in stride and starting from 1 and going on, so I can get better understanding of everything because that is what got me the statements. So I'm so glad that you explained it, and I'm like, wow, like it makes it so much easier to pick up and understand it. And like you said, like I said, people learn at their different, cases and pick up
That's right.
things differently than others. And that's what I found that I have been doing with you. Like it's just like a light bulb go off in my head.
Exactly right. Yep. Very good. I'm so happy. Okay, any other questions, comments, concerns for chapter 15 before we hit chapter 16?
Yeah, I got a question.
Go ahead, Jesse.
So when do you subtract inventory?
When do you subtract inventory? Okay, so let's take a look at our inventories. So Jesse, as you know, we have raw materials inventory, work in process inventory, and finished goods inventory. When I add and subtract, I add for materials inventory, when I purchase materials, I add to my materials inventory. When I subtract materials inventory, I'm taking it out of materials inventory and I'm putting it into work in process. So I'm subtracting it when I'm using it. So my materials inventory, I subtract from raw materials inventory when I use it in my work in process. All I'm doing is I'm transferring it from raw materials to work in process. When that's when I add it to work in process. So plus work in process when I take it out of my materials inventory. When I process it, after it goes through the manufacturing process, I take it out of work in process and I put it into finished goods. When I sell it, it comes out of finished goods and it goes to cost of goods sold. Does that help, Jesse?
Yeah, I understand.
Awesome. Very good. Yeah, it takes a little bit to catch on, but you'll get it. I promise. It's just when you go through the exercises in the book, it really helps to break it down.
Hi,
All
Professor.
right.
This is Fritza.
Hey, Fritza, what's going on? Go ahead, Fritza.
Hi, Professor. This is Fritza.
Hi, Fritza.
Professor,
Shh.
Go ahead.
Hello.
Go ahead. Fritza, can you hear me? I can hear you. Fritza, go ahead. Oh, okay. She'll come back. Okay. Let's go on to chapter 16. I'm going to stop the recording and then I'll start it again. So that way it breaks up.